These gaps in employment can be a super valuable opportunity for you to get a much needed mental break. And we can also take advantage of some tax planning opportunities along the way. So let's go through this example case study and look at how you can plan for a sabbatical while also having the end goal of financial independence in mind. Okay, so let's meet Mickey and Minnie. Mickey and Minnie are both married. They're currently in their mid-40s, age 45 and 44. And one of their main goals is to essentially take a 2-year sabbatical, but they also don't want to sabotage being able to retire at 55, or at least have the flexibility to retire at 55 if they wish to do so later in life. Now, let's take a look at their balance sheet, at least their assets at this point. So currently they have cash of around $100,000. And the important thing when it comes to your cash and taking a sabbatical is you don't want to deplete your emergency fund. And one of the ways you can actually save for a sabbatical would be actually setting up essentially a sabbatical fund. It could be a high yield savings account and get some nice yield on your cash while you're saving. Now, obviously, they don't have enough cash to fully cover a 2-year sabbatical, which we'll look at when we look at their expenses, but that's where their taxable non-retirement account comes in, and they have around $1.5 million in that account. Now, a taxable account can be a great account to use when funding your sabbatical because the tax rates are normally a lot lower to your normal ordinary income rates. You also don't have any sort of penalties for taking distributions. So this is the other account that you can use. And we're actually going to talk about how you can generate basically up to $91,000 in capital gains and still pay $0 in taxes. So make sure you stick around as we go through that. Next, we have their traditional accounts here. So their 401ks or IRAs, they have around $1 million in those. Now, because they're under the age of 50, we don't necessarily want to use those accounts to fund the sabbatical because you'd be hit with that 10% early withdrawal penalty if you use that money. So that would probably be one of the last accounts we want to use to fund a sabbatical. If you're actually planning for a sabbatical, one strategy would be to contribute up to your 401k to get the match. And then maybe you want to start putting funds towards a taxable account like the non-retirement account we have right here, or putting some of your funds towards cash if you're saving in the near term here. And lastly, we have the Roth account, which they have around $60,000. You could take your contributions out tax-free, but again, we want to leave that till retirement, let that grow tax-free from retirement. That puts their total assets at around $2.6 million. But let's start to look at their income here. So Mickey earns around $300,000 per year, and then Minnie earns $100,000 per year. They're both executives at the Walt Disney Company, so they have high incomes here. But let's break down their expenses. So their average monthly spending is around $14,000 per month. Again, that's including all their spending, including their mortgage payments. And then of their total income, they have around $120,000 a year in taxes, and that's made up of both federal, state, as well as FICA taxes. So those are all the taxes that we're factoring in. And of their savings, they're saving around $93,000 per year. They're maxing out both their 401ks and then heavily putting a good amount of money towards their taxable account each month as well. That's over 24% of their income that is going towards savings. And then lastly, they estimate they'll need an additional $30,000 each year during those sabbatical years. So that's going to go towards travel, flights, entertainment, and also adding any sort of extra medical cost or insurance coverage during the 2-year period. Now, looking at their assets, the key thing here for funding a 2-year sabbatical with your assets is having enough in both cash and a brokerage account. So whether you have employer stock in that account or just have been saving an account like that for decades, this can help fund your sabbatical. Again, avoiding the taxes you pay and early withdrawal penalties from your pre-tax accounts. But in order to make sure this is a good option for them and figuring out basically what they can expect to spend, we want to go through how taking 2 years off would impact their long-term plan of retiring early. Now, here's Mickey and Minnie's financial plan and what it looks like visually when we run the numbers here. So now, as you can see, each one of these bars is a year of their lives. So next year, they're going to be age 45 and 47, and their investable assets are at $3.3 million. Of course, there are a few assumptions in these projections that you should be aware of. So First of all, we're estimating a hypothetical investment rate of return of 7%, along with an inflation factor here of 3.75%. And we add in that higher inflation number to add basically an extra layer of conservative numbers into this. That way, their budget is a lot more flexible if they do overspend. And you should also know that we are having their expenses grow at that inflation rate over their lifetimes. Now, over time, if they continue to max out their 401ks and save into that taxable brokerage account, the trend of their plan looks really good, especially as it looks as retiring at age 55. But of course, as mentioned at the beginning, they want to know what would happen after taking 2 years off. So 2 years of number one, not saving, and number two, spending down some of their portfolio. Yeah, so how would that look? How would that affect their long-term plan? And these numbers are future value right here. So we're looking at 40 years of projections. The main goal here, again, is not precision, but to see the trend. And the trend is looking really good as it currently stands. All right, so let's see what happens when they take a 2-year sabbatical. Okay, so I'm gonna toggle this on now. So there's some variables that you should know. On the left, we're assuming that Minnie and Mickey both finish out 2023. So they're making that $400,000 gross salary for 2023. And then we're also assuming in 2024 and 2025, both Mickey and Minnie are taking those 2 years off completely. So 0 income during those 2 years. And like I mentioned, when I was going through their expenses, we're factoring in additional costs of $30,000 per year. We're also factoring in that they're going to stop saving completely. So they're not going to be working, so they're not going to have 401ks to contribute. And they're also going to stop their taxable brokerage account contributions. And we're also factoring in that later on, again in 2026, they can expect to have a similar salary, and they both start working during that year. So as you can see, clearly there is some value lost as far as you see the gray here above each blue bar is the value lost. But again, their goal is not in taking a sabbatical is not to maximize their net worth, but to maximize their life here. So we're okay with that. But let's look at some of the details, the cash flow details, so we can see what their estimated sabbatical spending might be. Okay, so what you're looking at in these cash flow projections is their cash flow over time, right? So in 2023, we can see that they're both age 46 by the end of the year. They have an income and salary of around $400,000 combined total. And you can see their net savings, the $93,000 we talked about. Their total expenses were $307,000. So we're taking all their taxes as well as their mortgage and all spending wrapped up in that number right there. And you can see that they don't have to withdraw anything, of course, because they're working and they're not taking any income out of their portfolio. If we look at the next year, when they begin their sabbatical, you can see their expenses drop significantly. And the big piece of that is because they're both not working and they're not paying any sort of taxes. So this $198,000 is basically a good ballpark estimate for what they might spend. Again, that's $14,000 per month times 12. And also we're adding in that extra $30,000 or so on top of that. Now that's going to be going over the next 2 years of them going through a sabbatical here. And again, the long-term projections still look good. Their assets still last past age 95. So the trend is good despite them taking a sabbatical, because they can go back to work after that 2-year period and still earn and save really well. So now we have a good ballpark estimates for spending during those 2 sabbatical years. And we can also see that the plan to retire early is still headed in the right direction from a long-term standpoint. This is why getting your expenses right is so crucial. And I've actually created a retirement readiness report to show you where you're at now and what sort of action steps that you may want to consider taking to increase your chances of a successful early retirement. And I personally go through your numbers, and I'm going to record a custom video walking you through the results and share with you things that people that are a few years ahead of you, have already retired early, are thinking about. So if you're interested in that, see the link in the description below. But like I mentioned, the goal at looking at these long-term cash flow projections is not for precision, it's for us seeing trends. And these numbers are conservative, that they can have that flexibility to make changes if they find themselves going above budget here. But a huge opportunity we have when you take a sabbatical that most people overlook is doing some great tax planning. Like I mentioned, there's a way that they can use their taxable account to essentially sell long-term gain investments to fund the sabbatical and pay $0 in taxes. So during the year of the mouse sabbatical, of course, we're assuming Mickey and Minnie's salaries will literally be $0. And the principle of tax planning is to defer income when your tax rate is high and then generate income from your investments when your tax rate is low. So let's look at an example here at how we can do some strategic tax planning. Okay, so what you're looking at here is a side-by-side comparison of 2023, so the year before the sabbatical, and then 2024 when Mickey and Minnie start their first year of sabbatical. As you can see, during the tax year of 2023, if we assume they finish out the year working, their taxable wages are going to be approximately $355,000. Of course, that's off after all those pre-tax deductions. And if we continue to scroll down here, looking at their total tax, assuming they take the standard deduction, federally, they'll be paying $66,000 in tax, right? That puts them in the 24% marginal bracket in a typical year. But if we assume, and looking at this right column right here, based on 2024 figures, they're going to have $0 in wages. So we don't want to let this go to waste. So first of all, how about we convert up to $28,000, at least up to the standard deduction, towards Roth here, right? And you can see $28,000 converted to Roth. What is going to do to their tax plan? And I'm going to pull up the tax report right here. So as you can see, even if they convert $28,000 from their pre-tax accounts to Roth, they're going to still pay $0 in taxes. And then also, we talked about taking some long-term capital gains. They can take up to $91,000 of capital gains, so generate those taxes. And then also we go back to the tax report and still stay in that 0% tax bracket for capital gains. But let me show you how this would affect a normal year. So again, converting $28,000 to 2024, no tax liability. But if we did a Roth conversion in 2023 while they're earning substantial income, that's an additional $6,780 of tax at that 24% rate on top of paying all the other taxes. So that would not be a prudent decision in a year where they're making that much money. So not only are they fulfilling a life goal by taking the sabbatical, but they're also saving nearly $7,000 in ordinary income tax, plus over $13,000 in capital gains. So that's over $20,000 in taxes saved while they're in Europe or whatever they want to do. So this tax savings really offsets a good portion of their 2-year sabbatical spending just through some proper tax planning. So the main takeaway here is that a sabbatical may not be the decision that's going to maximize your net worth per se, but it could maximize your return on life. And the point I want to make is that with proper planning, a sabbatical can be a great option to ultimately get the taste of an early retirement while still reaching your financial independence goals. And I do often see people taking savings way too far and saving more than they really need to, and this might cost them in terms of what they're missing out on in life. So I made a video on when you should actually stop saving for an early retirement. You can watch that by watching right here. Again, this is Matt. I'm a certified financial planner and advisor over at 1 Degree Advisors. If you want us to take a look at your early retirement plan and see how we can help optimize your situation, go ahead and click the link in the show notes to schedule a complimentary 15-minute call with me or anyone on my team. Thanks for watching, and I'll catch you guys in the next one.